Celsius Holdings, Inc. The better-for-you energy drink company, 3 brands, 1 PepsiCo distribution network, and the third largest energy drink portfolio in the United States.
CELH generated $2.5 billion in FY 2025 revenue at 50% gross margin, growing 86% as Alani Nu and Rockstar made Celsius the category captain across PepsiCo's network.
The story begins in 2004. Celsius Holdings was founded in Boca Raton, developing functional energy drinks with no sugar, no artificial preservatives, targeting health-conscious consumers.
John Fieldly became CEO in 2018 and pivoted Celsius into fitness channels, gyms, trainers, and health food stores. In 2022, PepsiCo invested $550 million and became the exclusive U.S. distributor.
In 2025, Celsius acquired Alani Nu for $1.8 billion, a second better-for-you brand with $600 million in trailing revenue. Rockstar US and Canada was acquired from PepsiCo in August.
The Celsius brand generates 58% of FY 2025 revenue, the original zero-sugar functional drink. Alani Nu contributes 40%. Rockstar adds 2% after its August 2025 acquisition.
North America drives 96% of revenue. PepsiCo's direct store delivery network covers all major grocery, convenience, and club store chains across the United States and Canada.
FY 2025 gross margin held at 50% despite 3-brand integration. GAAP net income fell to $108 million as acquisition costs, debt service, and PepsiCo preferred dividends weighed on the bottom line.
Q1 2026 delivered $782 million, up 138%. Adjusted EPS of 41 cents beat 29 cents. EBITDA of $195 million beat consensus by 28%.
Red Bull holds 35% US dollar share, the private market leader. Monster Beverage holds 27%. The Celsius portfolio now commands 20% of the U.S. energy drink market.
Monster's growth was driven by Coca-Cola DSD, the same playbook Celsius replicated with PepsiCo. Celsius went further, category captain status controlling energy drink shelf placement that Monster never achieved.
Celsius's moat is PepsiCo distribution lock and category captain status, controlling energy drink shelving at PepsiCo retailers nationwide. 3 brands span fitness consumers, wellness buyers, and mainstream drinkers.
The United States is the primary market. Celsius, Alani Nu, and Rockstar distributed through PepsiCo's direct store delivery network, reaching every major grocery, convenience, and club store channel nationwide.
Canada is active through PepsiCo Canada distribution. International is 4.5% of Q1 2026 revenue, up 55% year-over-year, with Europe and Asia targeted for expansion.
John Fieldly has led Celsius since 2018, guiding it from a niche fitness brand to the third largest energy drink platform in the U.S. through the PepsiCo partnership and 2 acquisitions.
Fieldly holds an accounting degree from the University of South Florida and is a licensed CPA. He joined as CFO in 2012, that finance background shaping the approach to the Alani Nu acquisition.
Celsius Holdings, the better-for-you energy drink company, $2.5 billion in FY 2025 revenue, with the Alani Nu acquisition and PepsiCo category captain status as the structural growth catalysts.
Q1 2026 beat on both lines, $782 million in revenue, up 138%, and ADJ EPS of 41 cents versus 29 cents estimated. North America drives over 95% of sales.
Celsius Holdings just put up 137% revenue growth. I know that sounds extraordinary. There is context, but the earnings beat is real, the margin expansion is real, and the Pepsi recovery is real. I am Hudson, and this is Charged Alpha.
And I am Lana. Celsius, ticker CELH, beat both revenue and EPS estimates in Q1 2026. The Pepsi destocking crisis is resolved. International expansion is the next growth vector.
Celsius Holdings was founded in 2004 and went mainstream after PepsiCo signed an exclusive North American distribution deal in 2022, investing $250 million and placing Celsius in over 300,000 retail locations nationwide.
The company has 764 employees in Boca Raton, Florida. CEO John Fieldly joined in 2012 and has led the PepsiCo partnership build-out. Market cap is $8 billion at 33 per share. Q1 revenue was $782.6 million. The brand targets functional energy, no sugar, metabolic health positioning for fitness consumers.
That consumer is the strategic advantage. Fitness and health buyers are more brand loyal and less price sensitive than traditional energy drink customers. Monster and Red Bull address a broader demographic. Celsius's narrower focus creates gross margin resilience and pricing power that commodity energy brands cannot replicate.
Q1 2026 revenue was $782.6 million against the street estimate of $710 million, a beat of $72.6 million, or 10.2% above consensus. The headline year-over-year rate is 137.7%. That number requires context.
Q1 2025 revenue was only $329 million, artificially depressed by PepsiCo's destocking. In 2024, Pepsi worked down a massive inventory overhang from the initial distribution launch, ordering less from Celsius for several quarters. Q1 2025 caught the deepest trough. So 137% EOI is a base effect recovery, not organic acceleration at that rate.
The genuine recovery is still compelling. Revenue climbed sequentially from $329 in Q1 2025 to $402,525.80 and now $782.6, 5 consecutive quarters of acceleration with destocking fully resolved. Gross profit was $378 million on a 48.3% gross margin, up from 39.5% in Q1 2025.
EPS came in at 33 cents versus the 29-cent estimate, a 13.8% beat. Operating income was $139 million on a 17.8% operating margin. That compares to only 2.5% operating margin in Q1 2025. In 1 year, operating income went from $8 million to $139 million. That is structural inflection, not just revenue base effects.
Net income was $85.1 million at 10.9% net margin. Balance sheet, $900 million cash, 0 debt, current ratio 3.8. Free cash flow trailing 12 months is approximately $300 million. Forward consensus. Q2 2026 at $850 million revenue, full year 2026 at $3.3 billion and $1.55 EPS.
The bull case on Celsius begins with international. North America is the established business. Pepsi distribution is normalized, shelf space is growing, and consumer trial is building. But international revenue is the next structural chapter. Europe, Australia, and select Asia markets are early stage for Celsius. The brand has not yet achieved the kind of distribution penetration domestically that would cap growth. Management has flagged international expansion as the primary investment priority for 2026.
The gross margin trajectory is genuinely impressive. 48.3% in Q1 2026 versus 39.5% in Q1 2025. That 900 basis point improvement in 1 year reflects multiple factors: the end of Pepsi promotional era discounting, operating leverage on fixed costs as volumes scale, and the premium positioning of the brand allowing Celsius to maintain price. If gross margin continues expanding toward 50%, the operating leverage implications for earnings per share are significant.
The fitness and health channel advantage is structural, not cyclical. As consumers shift toward better-for-you products, a trend reinforced by GLP-1 drugs reducing calorie consumption and increasing health consciousness, Celsius sits directly in the path of the largest behavioral shift in consumer behavior in a generation. Monster and Red Bull are not positioned to pivot. Celsius was built for this consumer from day one. At 27% implied upside to the $42 analyst price target, the stock offers a reasonable entry point for investors willing to hold through the international ramp.
The bear case starts with valuation. 100 times trailing earnings on 8% net margins and a headline YOY driven by base effects is demanding. Q2 2026 revenue growth must normalize lower mathematically as the Q 2025 base was not as depressed. The headline optic shift could trigger multiple compression even on solid absolute performance.
Consumer trade down is the macro risk. The retail price of Celsius is $1.50 to $2 per can. Under economic stress, health-conscious shoppers may reduce frequency or shift to private label alternatives. The fitness consumer is loyal, but loyalty has limits when household budgets tighten across the board.
Monster Beverage and Coca-Cola represent a formidable competitive threat. Monster has Coke's global distribution network and significantly more marketing resources. If they compete more aggressively in functional energy, through product extensions, pricing pressure, or targeted shelf space campaigns, Celsius faces a harder environment than it has navigated during its rapid growth phase. 3 watch points heading into Q2 2026. First, the revenue base comparison. Q1 2025 was depressed to $329 by Pepsi destocking. Q2 2025 was $402 million, a higher base. The YOY growth rate will look dramatically lower than 137% even on solid absolute numbers. Watch whether management guides Q2 explicitly so the street is calibrated, preventing headline optic volatility.
Second is international revenue. If international is the next growth chapter, Q2 should show measurable acceleration, geographic disclosure, new distribution agreements, or market launch announcements. Celsius's international business remains small relative to North America. If the Q2 call lacks specific international evidence, the bull thesis narrows to domestic demand alone, a weaker foundation than the full investment case implies.
Third is gross margin sustainability. 48.3% is the highest Celsius has ever reported. International scaling introduces different cost structures and competitive pricing environments. If Q2 gross margin falls below 46%, the Q1 record looks like a recovery pop rather than a new structural floor. Sustained gross margin above 47% is the operating leverage linchpin. Watch it closely next quarter. The balance sheet is a strategic asset. $900 million in cash, 0 debt, net cash of $900 million, current ratio 3.8. For a company generating approximately $300 million in trailing 12-month free cash flow, there is no financing pressure and full flexibility on capital allocation. No dividends, no buybacks announced, consistent with a growth reinvestment posture. International expansion requires investment in marketing, distribution partnerships, and brand building. The $900 million war chest is appropriate sizing for that mission.
The income waterfall shows the inflection. Revenue $782 million, gross profit $378 million at 48.3%. Operating income $139 million at 17.8%. Net income $85 million at 10.9%. Compared to Q1 2025, revenue $329 million, gross profit $130 million, operating income $8 million at 2.5%.
In 4 quarters, operating income went from $8 million to $139 million, a 17 times increase on a revenue base that roughly doubled. That magnitude of operating leverage, driven by fixed cost dilution and gross margin expansion, is the most important number in the financial model for the Celsius thesis. Options market heading into Q1 2026 priced approximately a 9% post-earnings move in either direction. That elevated implied volatility reflects the uncertainty around whether the Q1 recovery was genuine or a one-time normalization. Put-call ratio of 0.95 was close to neutral with a modest put lean. The market was not positioned confidently bullish into the print. Call open interest concentrated at the $35 and $40 strike levels, reflecting institutional positioning for a move toward analyst targets. No unusual pre-earnings options activity was detected, confirming the beat was not telegraphed by large-scale smart money positioning ahead of the release.
On insider activity, 3 sales under 10b5-1 programs were reported in the past 90 days by executive officers, scheduled, not discretionary. No open market purchases were reported, despite the stock trading near multi-year lows at $33. That absence is a mild negative signal worth noting. Management is not adding personal exposure at these prices, though the scheduled nature of the sales diminishes the signal value. CEO John Fieldly's equity stake remains substantial and tied to long-term stock performance. The company has not announced a share buyback program, which is consistent with the growth reinvestment orientation, but limits a potential technical floor under the stock.
29 analysts cover Celsius. Consensus is buy, 5 strong buys, 12 buys, 10 holds, 2 sells. Average price target $42, 27% upside from $33. Goldman Sachs upgraded from neutral to buy post-earnings. Morgan Stanley moved to overweight. 2 major institutional desks turning constructive on the Q1 print is a meaningful signal. Risk-reward is viewed favorably at current levels, with growth normalization and international execution as the key swing factors.
This episode is for educational and entertainment purposes only. Nothing discussed constitutes financial advice or a recommendation to buy or sell any security. Charged alpha may hold positions in companies discussed. Always do your own research and consult a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. Thank you for listening.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.